Monday's gap up, the greatest bull trap in all of 2025. Or was it? You see, the market's in a very interesting position right now that's bound to blow up accounts on both sides, for both bulls and bears. And what's going to separate the winners from the losers over the next few sessions is exactly what we're going to talk about today. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and build a logical trade plan for Friday. Remember, markets are closed tomorrow. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY daily time frame chart, but before we get into our standard analysis, I do want to cover 2 things that will prevent you from blowing up your account and keep you on the winning side of that equation we had mentioned in the introduction. The first thing you need the ability to do is adapt to a changing market environment. And the easiest way to identify this is just by looking at daily balance ranges. Look at this range here, 4-day balance range here, 4-day balance range here, and a multi-day balance range up here. Now, ever since the Powell plunge and the FOMC day, the balance range has expanded by at least a magnitude of 2, if not 3. So what's the action item that we need to take here to prevent account blowup? If you're still going to be respecting market structure, it's very likely that your stop loss needs to widen. And that technically means that you're taking more risk per trade. So to accommodate a wider stop loss, it's very likely, again, if you're trying to risk the same amount of dollars per trade, that you should be reducing your position size here. If you reduce your position size to accommodate that wider stop, you can still preserve your risk-reward metrics and win rate to hopefully have positive expected value. If you don't have a winning strategy in the first place, then that's something to work on first. But lower position size will allow you to take the same style trades with a wider stop, accommodating this wider market structure. Number 2 is navigating a daily neutral trend. I know it seems like everybody's calling for a market crash and oh my goodness, it's the end of the world as we start the brand new year, but the daily trend here has really just neutralized. It's not up and it's not down. Yes, we technically have highs. Yes, we have lower highs. Yes, maybe this is a lower high, but what's going on with our lows? We have lows, equal lows, and maybe the possibility for a higher low. I would call this a neutral daily trend. And this is completely different than what we were dealing with for a majority of 2024. So what's the actionable takeaway when the daily trend flips to neutral from what was a very long-standing uptrend? It's to take it day by day. Absolutely do not try to be a hero inside of this box. In this box, it's fair game for anything. Ping pong in the range. Maybe we break out and it's a failed breakout. Maybe we break down and it's a failed breakdown. Until we actually set a lower high under the range or a higher low over the range, the daily trend is going to remain neutral, with the opportunity to start showing us bearish activity here or showing us bullish activity up here. But inside of this box, once again, this area right here, it becomes very difficult to call this a daily clean trend. We're just chopping around back and forth. I mean, how many round trips have we had so far? 1 to the downside, 1 to the upside. That's 2, 3, 4, and 5 back to the downside. Just a crazy amount of volatility where anybody who's tried to be a hero, calling, oh my goodness, this is it, market's got to go break the new all-time highs, or even the flip side of the coin, oh my goodness, markets are going to break down and go to zero, none of those traders are being rewarded in this box. So the ability to exercise some patience here until we have clarity on the daily time frame trend, that is another virtue to prevent you from blowing up your account over the next couple of sessions. And again, accommodate those wider stop losses, lower your position size. That way you have just as many trades to take without blowing everything in one single trade where, oh my goodness, I'm over leveraged. I have to disrespect my stop because I'm going to get a margin call if you're trading futures or something. Don't do it. So there you have it. Those are the things that you should focus on as the market's navigating this very volatile, but just neutral daily channel that we're stuck in. So let's start to talk about our standard analysis now that we've gotten that out of the way. Of course, the bears are screaming from the rooftop, and rightfully so. We have highs, we have lower highs. We sort of have these equal lows down here. And the pattern in play, of course, is the head and shoulders. But as we've just said, from the neutrality of the daily balance range, the only time where I'm really going to get aggressive on that move is the possibility for a lower high underneath 580, 475 to potentially come in and close the election gap at 576.75. That's a possibility. If we look at the daily structure that printed on the Wednesday session, it's technically a hammer. So are we overly enthusiastic about, new money shorts towards these lows, as clearly buyers demonstrated that they were willing to step up here at 584.75? It certainly wouldn't be a top priority for me headed into the Friday session unless we end up opening on some sort of gap down. If we open on a gap down on Friday, what that does is it puts all of the buyers who potentially stepped up here at the lows, 584.75, off sides. And under those circumstances, a gap down only, would I entertain continued price acceptance underneath 584.75 for that move into 580.75, and the equal lows then would be extremely susceptible for some sort of Brigade bolt underneath to close the election gap. Once again, the target is at 576.75. And of course, we'll do another update on Saturday, so this is really just for the Friday session. If we end up opening in range for Friday, I would be neutral. Again, I would not try to be a hero. I would be patient in this balance range and say, okay, we're inside the previous day's range. Buyers stepped up off of these lows, but also, what's the flip side of this analysis that we've sort of omitted for now? It's just that the buyers had the opportunity to set a much better, a much stronger, higher low here over the daily line in the sand at 590.75. And this is what we were talking about in the introduction with the Monday gap up, the big old bull trap, right? We gapped up over the 50 SMA, over this level, of course, to start the week. And on Tuesday, there was absolutely zero response from the buyers off of the Friday high for a gap fill reversal. In a picture-perfect world, buyers would have sustained a higher low over Friday's high, or worst case scenario, something like this to hold up over 590.75. Now, obviously, that did not take place. So although the sellers are not continuing to pressure markets down here towards the lows, we can also see that the buyers didn't really do what they should have done if they were going to maintain what I consider the gift, right? Capital T, capital G, trademarked, registered, copywritten. The gift. Buyers failed the gift on Tuesday. There was no response off of 590.75. So what that means going into the Friday session, if we open in range once again, is sure, sellers might not be able to break down through this low, but am I really enthusiastic about upside pressure? Not really. The only time I would start to look for something is possibly a thin structure retracement, and it's really not even that thin. We'll see this on the hourly chart in just a moment. There's maybe a Brigade bolt out of the prior day's high over 590.75 because it represents that key daily level, right? This area right around in here. But what would really make this chart, strong on the bull side? I would say a recovery to then move over 590.525, and I would put this as being technically lower odds for the Friday session. But any sort of recovery that does this and then starts to set up this, now all of a sudden, okay, we know that we have a backdrop of bullish activity. And one of the reasons why you do not want to be a hero when the daily trend is neutral, possibly in the process of flipping to down, especially, this is the kicker, as the weekly chart is trying to do what? The weekly chart is trying to sustain that higher low that we have been describing for the past couple of weekly bars. It really kicked off with the Powell plunge. We had said, hey, as long as we're over 585.75, there's really no reason to be aggressive on the downside because the weekly trend remains in the upward direction, which is exactly why on the daily time frame chart, I'll just continue to reinforce this because, the difference between traders who have a 20 and 30-year career versus traders who have a 20-day career is the ability to stay in the game. If you try to be a hero in here and you blow up your account as the weekly trend has not resolved to down, as the daily trend is neutral with highs, basically equal highs, a balance range, right? Lows, equal lows, maybe a higher low. Until these things resolve and there's clarity in terms of the direction of the trend, being a hero in this box is not going to serve you well. So I would prefer to see bullish action resume up and over 595.25 to keep the weekly trend intact and keep this weekly higher low in force. It also prevents a breakdown of the December low, which statistically, if we remain above the December low in Q1 of 2025, it increases the odds that we have a green trading year of 2025. If we take out the low of December, it really turns into a coin flip on whether or not 2025 will close green. And if you want more on that statistic, you can go back and you can watch last Saturday's update video, right? So those are some thoughts and commentary from the daily perspective here about the range that we're navigating currently. If we take a look at the hourly time frame chart now, we can just continue to reinforce the idea that buyers did not step up whatsoever at the gap close. What you'll notice here is the second hourly bar of the Tuesday session is technically a hammer candle. We had buyers initially try to step up, but was there any follow through over that high? Was there any price acceptance back over the Friday high, which represented the gap from Monday, right? The answer is no. And as a matter of fact, you can see into the afternoon, we actually had consolidation inside of that Friday range. So did value progress in the upward direction? The answer was absolutely not. And we'll see this on the market profile in just a moment. So as we're dealing with this hourly chart in front of us, I think day by day is the only correct approach. I think that there might be a potential to scalp long side if we get something that looks like this, maybe. But even at that, you're in the midpoint of the daily range. So I would be reserved in my outcomes there. I would not hold on to that trade for, oh my goodness, new all-time highs are going to be here in the blink of an eye. Notice how that aligns with the theme of the daily trend being neutral, and you probably want to be reserved in this box, not be a hero. I might sound like a broken record, but like I was saying earlier, a trader who can last 20 years versus a trader who can last 20 days, you know your risk, you know where you have an edge, you know where the market's firing on all cylinders, and you know when to take the foot off the gas. That's really what I think is going on here on the daily time frame chart and the hourly time frame chart as well, just being in the midpoint of this balance that we're trying to resolve. Undoubtedly, if we just get consolidation down here, it will be consolidation in the lower third of the overall range. If I just zoom out a little bit now, we can see this, right? Any consolidation down here is undoubtedly bearish. It is not holding up here. The only thing that maybe buyers have going for them is the fact that potentially there's a higher low here, but I'd still just consider the daily trend neutral. Any breach of that area, once again, gets weak underneath 584.75. That's where I would start thinking about that election gap closing under 580.75, as we've already described in great detail, closes at 576.75. Okay, on a gap down, of course, as we mentioned on the daily, gap fill reversal probably keeps the sellers in the driver's seat here, and we would be looking for that harsh move to close the gap. There we have it one more time. If we open on a gap down and we get some sort of acceptance back in range, I would start to think a little bit more on the bullish side, but once again, even on a look below and fail of 584.75, I would still hold my breath just a little bit and not be willing to aggressively participate in this. Just noting one more time, right? The failure of the buyers on this gap fill reversal, the failure to hold up outside of what was a 2-day balance range. We had highs, right? So really, the buyers failing this gift on Monday really changes the tone to neutral at best, maybe bearish consolidation down here, reserved if it's going to be look below and fail. We need more evidence that buyers are going to step up. That's sort of how I'm approaching the market as we move into the final session of what is, again, a shortened week. Not a holiday week. Let's all take some time to remember Mr. Carter on the Thursday session. Here we go, market internals. To add some more context to what we've been talking about so far, if you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What do we see here? I think the main takeaway is thinking about what happened today as the market was volatile and sideways, right? So what I mean by that, I'm just going to zoom in individually on the ES futures. Volatile and sideways, right? But what's technically happening here from an internals perspective? Did we have neutral internals that were flat, or did we have slightly more bearish internals? And if you were watching for a majority of the day, you'll actually remember that the internals were leaning on the bear side. You had strong volume outflows from the session, not underneath negative 300 million, but off of the open. If I just go ahead and hide this study, what you'll recall from the open if you were watching vigilantly during today's session is that the opening breath was horrendous, right? We were at negative 7-1 on the NYSE. So strong volume outflows towards the open. You'll remember that we opened near trend lower zone on the advanced decline line. The index score was mostly negative through the morning session. This is since updated after the 4 p.m. close. Then over here on the ticks, if I zoom in on today's session, all under the zero line, sustained bearish pressure under the zero line for the first nearly hour and a half of the trading session. So as the market's going sideways, did we have bullish or even neutral underpinnings for the exchange level data? No, I'd actually think that there's a bearish divergence unfolding here inside of the market internals. So one more data point to remain reserved if you're thinking about a big upswing. And even if you're thinking about the downswing, okay, this is here, but you could take the same approach for the bears, right? I sort of would interpret this dashboard today as being bearish, but the flip side, to keep you a little bit reserved on the bear side as well, is just, okay, if the market internals were ultimately bearish off of this open, then why was there no follow through to the downside, right? On this push here to test underneath, and even over here, underneath the overnight low. Why was there no follow through if we technically had bearish internals, right? So again, being a hero in this box under some very mixed circumstances does not seem like a good idea as of right now. If we go on out to the market profile, something that I want to highlight is where we talked about value area needed to develop if it was going to remain bullish for the upcoming week. Monday did a great job of keeping value over the 6,000 mark, but as soon as the breakdown took place on Tuesday, value was overlapping to down. The point of control was easily back underneath that 6,000 figure. Today's session, value was inside the prior day's session. So again, we can lean into the daily structure. We know that this resolves as a daily hammer candle and value was inside of the Tuesday range. So was it bearish? Did sellers make progress in the downward direction? Technically, the point of control did migrate in the downward direction. Value area low, lower, value area high, lower. So, I mean, there's some small progress, but if the bears were going to run away with this thing today, it should have been a breach underneath the previous day's low, open the door for the bottom end of the range, the neckline basically of the head and shoulders pattern on the daily, and that just didn't happen. So again, I know it's not the answer that like 99% of traders want to hear. Everybody wants to know, okay, what's the holy grail trade? What's the thing that's going to make me $1 million overnight? But if you have that mentality in this current market environment, personally, I think it's a recipe for disaster. Now, I will be willing to say on a higher time frame perspective, right? Let's just go out here to the monthly chart. I'm willing to say on the monthly chart that pullbacks anywhere between 3 to 8%, I'm probably looking to be a longer term buyer here. So like, don't get me wrong. I want to participate in the longer term accounts, but as a day trader trying to navigate the intraday volatility, trying to make a heroic call that the market's going to breach to new all-time highs over the span of like, 2 trading sessions, it's a fool's errand. It really is, and that's not the approach I think is appropriate given what we've talked about so far today. So enough about that cautious stance. Let's move along. Let's move through the analysis to the NASDAQ side of things. Let's see what's going on with the daily chart here. We can see it's very similar. Here's our balance range. It's been very tricky in this box. The market gapped up. It did not produce a higher low over 517.75. We've updated the level slightly. The line in the sand we were using prior is still on the chart. It's 514.85, but this level should have yielded, right? If the buyers were going to build a new uptrend, it should have yielded a higher low. That did not take place. We closed inside of the multi-day balance here. The only difference between the NASDAQ is that, and the S&P, is that it is holding the daily 50 SMA, whereas the S&P, if I just quickly flip back over, is back underneath the daily 50 SMA. And another interesting study you could throw on here is the 20 SMA, right? You can see that this is continuing to act as a little bit of a headwind for the market, rejecting here, look back to the last major daily downtrend, rejecting here. So you do have the 20 at play and the 50 at play. It's a little bit more bearish on the S&P versus the QQQ NASDAQ. It's in between the 50 and the 20 up here. So keep that context in mind, but once again, not being a hero in this range really strikes me as being the primary idea. How interesting would it be, just to play devil's advocate? You guys know that they always call me the permabull of YouTube. Wouldn't it be something if this played out as an inverted head and shoulders, your neckline was a trendline break, and we got something that looked like this? How interesting would that be on the NASDAQ to just totally invalidate the daily head and shoulders over here on the S&P 500? I would that's some poetic justice, if I do say so myself. Anyhow, let's drop it on down to the hourly. Let's see what we can learn about the price action here. So again, lack of gap fill reversal off of the Friday high on Tuesday. You did get that same second hourly hammer candle with no price acceptance over its highs, instead price acceptance underneath its lows, and also inside of this range from back here. I think the threat on the NASDAQ, of course, is that sustained lower highs under 517.75, produce bearish consolidation for a bear flag, and we'll call it when 510, if 510 gets taken out, we'll be looking for the previous all-time high retest, which is a great reminder actually for myself to just continue to bring up that multi-time frame, competition of the time frames. The time frames are butting their heads against one another. On the QQQ weekly, I think it's a good reminder that 503.25, it's very, very difficult for me to say anything aggressively bearish about the NASDAQ if we're over this level. I mean, from a very technical perspective, all this is a simple weekly bull flag retesting the breakout point. I would not change my tone to being aggressively bearish if we're over 503.25. I think what a lot of people seem to forget, just as we're on this topic of like reflection and what's the market doing, how should we interpret the market here, something a lot of people forget is if the market is going to go down like an Armageddon amount, we're talking like 80%, not 8%, I'm talking 80%. If the bubble is going to burst, oh my goodness, it's worse than the great financial crisis, it's worse than the dot-com bubble bursting. You don't need to be the first one in the door here. If it's going to go down 80%, you can change your tone as a trader underneath 503.25 and still capture a majority of the move. So there's just, a simple reminder that sometimes calling the top, trying to get involved at the tippity top of the move, it's really going to leave you with more paper cuts over time than it is that massive payday when once over the span of a full trading career, you might get it right. Just think about Michael Burry. He got it right once. Goes down in history as being the guy who called the top. How many tops has he called since then? How many times has everybody said, okay, that's it, market top is in, market's going to crash, it's going to go to zero? Those paper cuts, I mean, he already made his money, so he's set. But if you have not made your money in the dot-com bubble bursting, if you have not made your money in the great financial crisis crash, you're just suffering the paper cuts until maybe at some point, if you're lucky, you happen to be involved in the right place at the right time for some Armageddon crash in the future. So he's the permabull of YouTube. He doesn't believe in a market crash. That's me. Chalk me up to that. I'll start changing my tone. You guys know where, under 503.25 on the QQQ. We've covered this. We know our ups from downs. Consolidation down here is admittedly bearish. We will trade this as a scalp under 510 into 503.25. I will not overstay my welcome as a short down here. I will, in fact, be looking for a counter trend to move back in the upward direction. If that does take place, the first higher low back over 510, count me in, coach. I want to be long here. I want to be long there for a weekly higher low to be set and the opportunity to trade the range back in the upward direction. If we find acceptance underneath 503.25, you guys know the deal. I'm changing my tone if the chart looks like this into the future. If we do get a Brigade bolt over 517.75, there is some thin structure to retrace here, so maybe this is a tradable idea. But one more time, just as a general reminder, in this box, you're sort of pushing your luck thinking that you're going to get a big outcome in one direction or another, right? If we are going to get that poetic justice I was talking about earlier with the inverted head and shoulders, where's your neckline? It's the trend line break. You'd have to be a little bit more patient, probably looking for price acceptance out here over 524.75. Let's move this over to the NASDAQ market internals, and we'll see a very similar divergence to what we talked about over in the S&P. Huge volume outflows, technically a cumulative build on the tick that's negative, but more importantly off the morning session. Look at how suppressed this was. In the first 15-minute bar, the high of that bar was at negative 687. Very, very bearish off of the open there. Underneath trend lower zone on the advanced decline line. So it begs the question, why did the NASDAQ not break down? Do we not have stronger sellers? But also, if the NASDAQ is just going sideways here, maybe that's a bearish divergence that at the exchange level, we should probably be thinking about further downside, not a miraculous recovery. So conflicting indications on that. Let's jump on over to the good old market profile for the NQ futures. Let's see what we can see here. I realize I didn't point you to the tutorial over on the ES when we were looking at the market profile. So if you're not familiar with this type of chart, check out the video tutorial in the top right-hand corner. Similar indications, just noting that if you take your highs right across the top, value area on Tuesday, value area on today's Wednesday session, certainly lower. Okay, so there's that out of the NASDAQ. It reinforces basically everything we've described over on the ES futures. Let's jump back over to the platform. Let's finish it up with the good old Rusty Russell. Let's see what's happening on the daily time frame chart, because actually weekly time frame chart, let's stay on the daily. You guys, I have faith, are certainly brilliant, and you can all see that the weekly breakout level, which acted as support back here, is continuing to act as resistance. So the weekly lower high threat is still very real out of small caps. And I think it's going to be exacerbated with the possibility of stronger than expected labor data coming out on Friday morning. We all know that the sick and twisted relationship right now in the market is strong labor data is bad for the market because it means that Jerome Powell is going to keep those rates higher for longer. The 10-year yield has a path to 5%. if that's the circumstance, right? So that tougher operating environment for small caps is going to keep the pressure on over here. So let's call it for what it is. It is absolutely a bear flag on the daily time frame, rejecting underneath the weekly lower high line in the sand. And for now, I would just be thinking, okay, as long as we're underneath 224.25, bearish pressure continues. The only time I would be constructive for upside is a higher low over 227. Doesn't seem likely, considering if we just drop this immediately to the hourly. We did have that gap up open on the Monday session. Gap fill reversal on Monday morning, which was different than what we saw in the S&P and the NASDAQ. And then you'll notice, even after repairing the structure underneath, the market still rejected that weekly lower high line in the sand, 227, the breakout level. Did the same thing on Tuesday morning. You saw a quick rally to the upside, which was different from the other markets, right? And then you saw this big snap lower. And lo and behold, what has it done? On the hourly time frame chart, this is another pure play example of a look above, failure, targets what? The bottom end of the range. 218, so mission accomplished, all set from the sellers. So any consolidation that persists in here remains bearish. Under 218, we're opening the door to the downside. I would even argue at this point, tests and rejections for lower highs of 224.25, that's a bearish trade, right? Absolutely. Lower high from here to here keeps you inside of the bear flag consolidation. Risk, reward to the downside, using the same approach we talked about in the S&P, right? That's a blanket statement for the market. Wider stop loss here, smaller position size, wider target. Also, right? So that would be the trade idea. That would be the ideal setup out of small caps if you want to remain bearish. Once again, if it's going to be constructive, get me up here, then we'll talk. But for now, bears have the edge. Let's take a look over at the Rusty Russell internals. See what we can glean from this screen over here. Not as bad on the volume outflows, but still definitely down. The advanced decline line did trend a little bit closer to the zero mark relative to the S&P and the NASDAQ. And over here, our cumulative build actually closes green. So interesting stuff out of the Russell, from that perspective, trying to claw back off the bottom end of the range. But for now, it's a range trade until proven otherwise. This, to me, does not look like new money buyers stepping up at the lows. If it was new money buyers, you would see the volume flows reflect that and be more severe in the upward direction. Simply wasn't the case. So let's finish it up. Final take on the Rusty Russell is our market profile, and then we'll move into our sectors, and we'll be quick through the remainder of the analysis because ultimately we only have one trading session left in the week, and we'll update you again on Saturday. So that tutorial we already pointed at in the NASDAQ, we're good to go there. What do we see happening in the Rusty Russell? Remember that this ultimately, let's actually go back. I want to make sure I'm not misleading you here. So we want Friday's high. That represents the top end of the flag, right? Friday's high. Friday's high would be right here. You'll notice that value on Tuesday, value on today's session firmly underneath the top of the range. So undoubtedly, bears have a little bit of an edge here. The only thing that I don't think we talked about in the ES and the NASDAQ is that there is a poor high from the Monday session on the Russell. If we take a look at the NASDAQ, there's a poor high on Monday, just lack of material excess, that single D print at the very top. How about the ES over here? I would say a similar comment, lack of material excess in E period to break out and really set an excess high there on that Monday session. So the high is poor. You could carry that forward. It's such a small bullish data point. You don't go long just because there's a poor high up here. You just carry it forward in the narrative, right? That the auction did not complete itself at the top end of that move. Let's get back on over to the charts. Let's take a look at what's happening with the sectors. Let's take a look at the weekly performance first, then we'll go through the structural charts. So healthcare leads the way, energy leads the way, materials lead the way. I don't know about you, but that certainly smells a little bit more like risk off than it does risk on. We know that the XLV is a D for defensive sector. It's now the fourth heaviest weight sector, so that is worth noting here. Energy is not inherently defensive, but it is lightweight, and that should not be leading any market move in the upward direction. And the same thing with materials. It's the lightest weight sector in the S&P 500. So that's, the only thing that would sort of counterbalance, like, oh, it's a big, bearish risk-off rotation. The market hasn't gone anywhere, right? If the market was pushing new all-time highs and the posture looked like this, I'd be concerned. But the fact that the market's just more so in this consolidation range, yes, it appears to be defensive, but it's not like we have a divergence that's shortable in the market because of that performance, right? Instead, we would just look at the net performance of the heavyweight sectors like semiconductors down big time, almost 2.5%. With the NVIDIA, micro crash of 2025, we all survived the big crash of 2025, right? It's crazy. I'm not going to go down that rabbit hole. XLY down 2.33%, heavier weight risk on sector. XLK, the heaviest weight risk on sector, down just shy of 2%. So you can start to see where the pressure is. It's those heavyweight components that are not really playing along for some sort of miraculous recovery back up to the highs. If we look at the structural charts, healthcare is just hardly going for a counter trend move. I mean, this thing got absolutely beat up ever since, September highs back here. We all know that the election and announcement of RFK, sent this thing spiraling, got even worse through November over here. We have these fundamental headwinds, but from a technical perspective, you cannot ignore that this is just simply in a daily downtrend, a weekly downtrend at this point. It's an ugly chart. So any sort of counter trend move over here is still that. It's a counter trend move until proven otherwise. So big risk off rotation, more like just a counter trend move out of the XLV. If this breaks the box, I'd still honestly be looking for a daily lower high to be set up against the 50 SMA or underneath this inflection point here, which was the severity of the gap down open and then continuation. That's 143.75. Moving along. Energy, a little bit of a counter trend move, but again, in the context of what? Just a range rotation. Here's a really wide range out of energy. Looked above, failed, hit the bottom. Looked below, is it going to fail and hit the top? Maybe. That rotation kind of just keeps us neutral in the market until this can sustain a move underneath 85.25 or over 94.25. At this point, you've established a swing range. And until we have swing acceptance out of that, it's really just balancing until proven otherwise. So we'll talk about it from an inflationary perspective, but not helping the narrative of the market right now. Materials getting absolutely beat up, and we know that we've been using the XHB as well, home builders, as a proxy to just indicate the cyclical side of the economy. It's not going so well. You can see this continuing to grind in the downward direction. Not a shocker at all, considering what's happening with interest rates. So as this remains divergent to the S&P 500, that technically leans into a little bit more of the bearish side of the data points, right? Here's semiconductors, another slightly disappointing chart as we come into the deeper components of today's analysis. Look at the balance range and the glorious gap up on the Monday session. Again, think about what should have happened in a picture-perfect situation. Gap fill reversal, but more importantly, partial gap fill reversal to stay over the top end of the balance range from, this... Geez, how many months was this? 3-4 months now? Right? Ideally over 256 would have kept the bulls in control. There is this micro high in here that is getting a hammer off of it today. So I wouldn't throw in the towel yet on the SMH. I do think that there's an opportunity for maybe, even if it's just a higher low from here to here, if this can sustain itself, then great. But for now, it is starting to threaten, and I would be more open-minded to look above and fail. We've seen this happen once, twice, third time. I mean, it's very possible. So 256 is absolutely a must watch out of the SMH as this market moves forward. As I've said on X a number of times, this is the most important chart for 2025 in my opinion. Next up, XLY. What do we see over here? Pulling back. Daily downtrend has now been established with a multitude of lower highs and lower lows. Weekly higher low at the 50 SMA provides the competition of the time frames. I would be mindful that this would get me back on the bull side, inverted head and shoulders. Over the 227.50, I would start trading this back long, or at least use it as a bullish influence for the S&P 500. Until proven otherwise, I would be sort of neutral in this consolidation here. If it breaches the 50, I'd be more concerned. Definitely a headwind. Next up, the tech sector. It's another balance range. Does this shock you, considering what's going on with the S&P as well as even the QQQ? It shouldn't. It absolutely should not. So balance range happening up here. I think that just like the S&P and the NASDAQ, it's one step at a time. Don't be a hero over the highs. That makes sense to me for long-sided ideas. And if we breach this gap close and find acceptance under 228, that's where I would start to throw in the towel on the long thesis. One thing I will say here and reinforce is that we do have a poor high up at the top end of this move out of tech. It doesn't mean that it needs to get taken out today, tomorrow, the next day. It doesn't mean it needs to happen in the blink of an eye, but it does mean that the auction did not end properly here at the all-time high. You can count on a handful of times. I don't even think a handful of times because they've all simply been repaired, trading at new all-time highs. You can count how long these have held in the past, and it's not very long. This always is going to get repaired up here. It's the improper end of the auction. So again, probably a slightly more bullish data point on that, but it doesn't have to happen tomorrow. It could happen 2 weeks from now. It could happen 2 months from now. So anyhow, that is 242. Let's move along to real estate getting beat up with higher interest rates. It's a lightweight component of the S&P. It's not going to make or break stuff here, but it is making new swing lows. That is bearish. If we take a look at utilities, underneath its big overhead supply, a little bit of a hammer on today's session, so kind of neutral through that. I would think if it makes a new swing low, bearish pressure for the S&P 500, so watching that 74.50 zone right over here. Next up, we have consumer staples. Is it going to load? Do we have data issues? What's going on, Thinkorswim? Okay, let's try the TLT. Is the Wi-Fi down? Is the Thinkorswim platform down? I don't know. Maybe it's under maintenance for, maybe it's under maintenance. Can we get the XLP? Here it is. There we go. A little bit of a pause there. XLP, what do we see? Definitely new swing lows. This is D for defensive, so the fact that this is a lightweight sector and it's a defensive, come on. Defensive and lightweight sector, not really concerned about the chart, but of course a headwind for the market. TLT, bonds are getting beat up as interest rates continue to move higher, so a big gap down over here. It's trading through the gap. And an interesting thing to note here about the TLT, I think this is a misconception. You see this online all the time. And I've sort of talked about this chart as well. If you zoom out to a monthly max available time frame, it looks like, oh my goodness, it's the all-time low in the TLT. It can't possibly go any lower than 82 or 80. What is the low down here? I think it's 81's low. 80.51. 80.51. Back in what day was that? March 1st, or the month of March 2004. The TLT can absolutely go underneath that level, right? Obviously, interest rates have been over where they are currently now. They've been much, much higher. So TLT can continue to get beat up underneath that 82.25. I think it's worth taking a long attempt down here, even if it's just as a trade, but understand that it's not a holy grail level just based on the data that's available. So I did want to clarify that. I am still short the 85 puts. You can see the short strike down here. I'm happy to let them expire worthless or just have them assigned and take the shares at 85 and hold them to farm the yield until we can ultimately sell that for a profit. I am a believer that rates will at least get cut once through 2025, and we're towards the top end of the cycle there. Anyways, moving along, let's jump over to communications, a heavier weight component, risk-on component of the S&P, trying for that inverted head and shoulders. It would need to be over the neckline here to get interesting. As long as it's over 97.25, it's a neutral pressure for the S&P. If it starts breaking down, I would say underneath these lows, probably 96.30s. If we're under 96.30s, yeah, the gap closes the threat, and it's probably a headwind for the S&P. So really, taking each of these sector charts day by day with the S&P day by day, I believe is the proper approach here. I think we've seen a mix of bullish and bearish looking charts so far in heavy and non-heavyweight components. If you look at the XLF, unfortunately, this does lean a little bit more bearish with that lack of acceptance over 48.70. So to me, it's starting to suggest more of a bear flag down here instead of what could have been double bottom on Monday, then looking for a rotation over this level here. The only reservation I have about calling this an outright bear flag is technically what's happening with JP Morgan. We could just go here now because it's relevant to the analysis. Look at this consolidation in the midpoint of the range after I look below and fail. I still think this is in play for higher based on the failure of sellers here and the consolidation we've seen sideways as the market gets beat up a little bit. So what does that mean for the XLF? Probably, able to hang in here and not really cause aggressive downside pressure in the S&P market. So balancing those two charts side by side. Industrials, 8% of the S&P, yeah, it looks weak. It's a bear flag down here, undoubtedly in a daily downtrend now underneath this. Weekly is in jeopardy. You could get a counter trend move, but I'd be thinking about lower highs being set underneath this until, unless it does this and then pulls back for a higher low, I change my bias to back on the long side on this higher low, not this attempt up here. This higher low is where I would then change to being long again. Okay, so that's your XLI. Moving along to the ratio grid, we could try to speed through. I know I said I was going to try to speed through some of the sectors, but we ended up spending some time. If you're not familiar with this screen or how to set up ratios on Thinkorswim, check out the video tutorial in the top right-hand corner. This still looks okay. Pulling back over the 50 SMA. This could use some improvement, but we just talked about JP Morgan possibly pressuring that higher. This is not the end of the world. I would be concerned if it sets a higher low over the 50 SMA. This is not a concern. This is not a concern down here. If we want some specialized ratios, we could take a look at these. This still looks like it's just balancing out. This is not inherently bearish. No issues there. Same thing happening here. Not bearish. This over here. Not bearish. This over here. Possible higher low. Absolutely bullish. So you're not seeing, even though I was talking about, okay, healthcare and energy and materials are outperforming, I sort of mentioned that the S&P was not breaking to new all-time highs under the circumstances of those outperforming because I don't think it's a risk-off rotation. I think it's just a balanced market in the S&P 500 until proven otherwise. The yen carry trade is an absolute non-issue as of right now, so NVIDIA blowing up is not at all related to that, in my opinion there. It's simply a reaction from, it could be a couple of things, but mainly the gap up and the taking profit off of those highs. Of course, you have Jensen talking at the CES conference as well. Let's move along to the dollar. Let's start talking about some of this stuff over here. Dollar continues to break out. I mean, it's holding over the previous pivot high here. If I drop this down to a daily, you can see this with some clarity, right? I mean, a very classic example of a Brigade bolt. Another Brigade bolt here, holding up over that breakout point, 107.50. As the dollar is above, I would continue to expect rates moving in the upward direction. So speaking of rates, I mean, here they are. Let's take a look. This is the daily. This is the weekly down here. We've broken the trend line from this, and this. We're over it. We've set a higher low after breaking. I mean, it's got a clear path up to this equal high, which is 5% on the 10-year. This has put in a Brigade bolt just like the dollar over this previous area of resistance. Yes, rates backed off ever so slightly today, but I would, again, the path is there to 5%, especially if that labor data comes in stronger than the expectations on Friday, which could easily be the case, which we'll talk about in just a second. But before we go there, I do want to at least mention gold as a currency on the topic of dollar and rates. It hasn't broken out yet. If this did break out, I would start leaning into that as a slightly more bearish data point, like a flight to safety and a stronger worry about wave 2 of inflation, which in my view is what we have to worry about most when it comes to the fundamentals based on PMIs that came out on Tuesday. Let's go inverted ZT. If this breaks out, I know, again, it sounds insane to say, but the Fed's rate cutting campaign is easily going to come to an end if we're over that handle here. So basically, if the 2-year makes a move higher, the Fed has to follow suit. Otherwise, there's just too much of a disconnect from the market, and if the Fed doesn't cooperate, something's going to break, and it's going to break big time. So let's move on over to the Fed tracker tool. Speaking of the Fed, we'll knock out some more fundamentals here. You can see that the market is only pricing in one of those rate cuts, and they've pushed it all the way out to the second half of 2025. There's a lot of conversation right now that there might not even be any rate cuts in 2025. Again, on the TLT, I expressed that it's my belief. I do think, and I've done some digging based on inflation metrics for the 2025 Outlook report, the fundamental research we've been conducting here. I do believe inflation is on it's at a point where the Fed, if they keep rates higher for longer, remember that as inflation goes down and interest rates are held stable by the Fed, real rates are technically increasing, right? So if the Fed's going to try to accommodate a neutral real rate policy, they should be cutting, even if it's not a lot, a little bit. And one cut could potentially achieve that neutral policy if inflation does not subside in a big way. So anyhow, the point being is this rate cut keeps getting bumped further out. And on strong labor data, I would continue to expect that this gets pushed out later and later. And that's just the market's expectation of what the rate cuts will look like. Remember that the Fed has ultimately outlined in their SEP that they believe they will cut rates twice in 2025. They also believe, and this is what we want to focus on for the Friday session, that the unemployment rate net in 2025 will end up evening out towards a 4.3. Now, if we take a look at the economic calendar here, let's go over to this one here. The expectation here is for a 4.2. So there's a very small margin of error that the Fed has basically, and the market's perception of what the Fed will do around this report on Friday. So anything stronger than expected at a 4.2 keeps the Fed in a pretty good spot, right? And the market will likely price in that those rate cuts are being pushed out. The biggest issue with why the market sort of continued to push the rate cuts out more aggressively on the Tuesday morning open is because of what happened here. If we take a look at the economic data that was released at 10 o'clock in particular, 10 o'clock, ISM Services PMI comes in hotter than the expectation at 54.10 versus the consensus view of 53.3. And if you look at the actual prices paid, which is this line item down here, what you'll notice is that this was the hottest component of the three that get reported, 1, 2, and 3 here, on the PMI report. So a 64.4 is absolutely inflationary versus the consensus view of what would have been a mild downtick from previous at 58 to 57.5, right? So if you go back and you look at the S&P 500, just so you can connect the dots from a fundamental perspective, right? I think that this is maybe an interesting exercise. If you look at Tuesday, when did the selling step up? Right here at the 10 o'clock time frame, because that is exactly when the PMI report was released, and that's when the market said, hey, inflation with a big I is an absolute concern. The Fed is not going to cut rates. The market doesn't like that. It, of course, moved lower. That is what's going on from the fundamental perspective. And once again, I do think that on Friday, you got to be on the lookout for a stronger than expected report to force the market lower, because Jerome Powell is not going to be, or he doesn't need to cut as aggressively. He does not need to save the labor market, right? If you look at JOLTS came in way better than the expectation. So there's no concern here that a huge unemployment recession is going to come around the corner and knock the market, or I should say the economy, those are two different things, on its rear end, right? So a little long-winded in the commentary here, but this is likely going to come in stronger than the expectations, and you can continue to see why just based on the continuing claims. Continuing and initial jobless claims are just huge downticks here, which makes sense seasonally, right? We talked about this in the live stream this morning. No employer is going to say, hey, Merry Christmas, Happy New Year, you're laid off. Usually happens around, anywhere between February and April. So if we're going to see an uptick in unemployment, that's the time frame to be looking for. It's not this report for the Friday session. All right, we've talked about that. Earnings calendar is an absolute nothing burger, nothing to pay attention to over here. Things get more interesting on January 15th when JP Morgan kicks off big bank earnings. And with that, we'll jump back on over to the platform. We'll finish the job over here, and we'll see what's going on with the remainder of the risk appetite indications. TLT ratio to the S&P is not budging. It continues to look quite risk on, in my opinion, over here as it trends lower. Bonds are continuing to signal that inflation is an issue, and once again, Tuesday is the day that this upticked. I know it's kind of just minor in the grand scheme of things here, but that is totally reflective of what we just talked about in the PMI report. If we look at the credit spreads, they are expanding here and remaining for a higher low over the 50 SMA here. What does this align with? The first commentary we had on the S&P 500 about volatility expanding even if the VIX itself isn't over 20. So please understand that. If you look at high yield credit spreads, high yield just in general in isolation, this is one of the only, maybe not only because the weekly uptrend is still intact, but it is one of the more bullish data points here, suggesting a positive divergence to the S&P 500 down below. You'll notice the higher low versus the equal/lower low that's being produced in equities. So if the high yield is going to be correct, we should be looking for that rotation higher. Bitcoin still looks like it's got a strong risk appetite consolidating up here in the flag. I will continue to say that the Saylor shift ratio remains under the zero line here. So if we take out the shelf of lows, it would not be all that much of a surprise to see a thin structure retracement to retest the top end of this flag here. Technically, the breakout level I was paying attention to was this, but we could probably update this in real time together and put a new retest level on here together. That is going to be around, let's call it 71.5. 71,500 in the big BTC is going to be your big retest level. If we can grab longs there again, to me, it sets up a great opportunity for risk reward, especially if the broad market remains risk on headed into the mid stage of 2025, even early stage 2025. Total breadth has been deteriorating here on new highs versus lows, still underneath the zero line. Yes, the 50 SMA saw a small uptick this week. That's based on the gap up from Monday, but the 200 SMA has been lost more so than the 50 SMA has been recovered. And to me, that's a little bit more telling, right? As the 200 gets underneath 50%, that would be danger red ranger. You can't really afford to have a big bullish bias if a majority of stocks are starting to trade underneath their daily 200s, right? So with that, we will move along to the RSP. Of course, equal weight S&P is still in this bear flag consolidation on the lows. A little bit more of that bearish data point here. It is in a bearish divergence to the broad market, and at least in the weighted sense down here. Similar comment on the equal weight NASDAQ. Dow Jones Industrials is still divergent over here. Not a big shock across those. VIX, as we said, is still technically underneath 20, which is, from a very bare bones analysis perspective, bullish. But what did we talk about with credit spreads, right? They're expanding. So would I expect volatility to stay here? Not really. We talked about the VVIX over the weekend video and how this was trying to hold these higher lows. And if it just remains over 103, that's enough to get the market on edge. And we saw the same thing over here in the volatility futures, which I'm going to give you again the quick breakdown. This one up top compares for a backwardation versus a contango. We're getting closer to the zero mark. So technically, if you're positive here, you're in contango. If you're negative, you're in backwardation. Backwardation is bearish for the market. And that just means when the front month volatility, if I go over to this tab here, let's go /VX for the VIX futures. So front month, let's clear that up. Front month volatility is at 1790. Back month, as we'd call it, is at 1830. So there's less volatility now than there is apparently forecasted for the future. But you can see that we have, about 40 cents of contango currently. As you go out to the next spread, which would be February versus March, it's just reduced to 25. Right? So it's about just less than half as much. And you can continue to see that that's reduced even further as you start dealing with April and May. And it's only 5 cents of contango out there. So the market itself is not really bought into the idea that volatility is a nothing burger. If it was, this would be much wider, this would be much wider in here, so on and so forth. You get the idea, and that would be more comfortable for money managers to allocate capital, right? Let's move back over to this screen because I do want to finish up here today with the skew. We haven't talked about it in a little bit, but as the market remains volatile here, actually a majority, not a majority I should say, but some of the black swan bets have been coming out of the market just a hair. And this, again, as you know, the topic of today's episode is patience, one day at a time, right? This would actually stack up as a bullish data point. So we're getting conflicting information there out of the skew. But volatility itself, I would say, remains elevated, which, if you're going to prevent account blow up, please just be respectful of that rule that we talked about in the very beginning of today's analysis. If you're trying to risk the same number of dollars per trade, lower position sizes will save you. All right, your targets are wider. If you're trying to risk more capital in a volatile environment, then fine, by all means, use the same position size, but please respect the wider stops that are going to be required, right? Anyways, enough about that. Let's jump on over to the core list of companies. Let's rip through it real quick. So any good setups into the Friday session? NVIDIA, it's a must watch. It's a must watch after the big Armageddon crash here of 2025. Big retest of the inverted head and shoulders neckline, right? You've got this here. You've got the 140 mark. If we can support over it, great. Maybe we go back to the highs. It's a possibility. The daily 50 SMA is here as well. The one thing I would just call out is you don't want to be premature to the party. I would say that over today's high gets interesting. That's a hammer high breakout, of course. But if you take it down to the hourly, you can see why as well, right? It's the intraday consolidation off of the Tuesday session as well. So consolidate here, show me the Brigade bolt. Maybe we have an hourly inverted head and shoulders over 143.25, thin structure retracement, expecting something up here at 149.25, which primarily comes from back here, that big shelf of resistance. So NVIDIA's primary outcomes, at least that I'm willing to trade into the end of the week, would be if it shows me this, we will participate. If it's just noodling around down here, getting sloppy and choppy, not interested on Friday. We'll wait for a better setup next week, perhaps. Monday, I'm thinking Microsoft Monday. Not an interesting chart at all either. This is perhaps the epitome of what we have on the S&P and QQQ daily, right? This is a balance range in the midpoint of a balance range. It's in a daily downtrend technically with highs, lower highs, lower highs. You've got these lows. I mean, it's playing nicely with the short and little Brigade bolt here underneath 426.85, but today's session was just brutal, really across almost everything, at least in the morning session. They're very, very sideways session today. So is it bearish? Yes, but is it a new money short right here in the midpoint of this range? Not so much. I really would not have that as a focus. So moving along, Apple is interesting to me as a potential long on the look below and fail of this level here. Opening drive to the downside this morning, got bought right back up, found a higher low over 241.25. If this turns into an hourly double bottom, if we get something that looks like that, count me in, coach, over 245.75. It's interesting back up towards the highs. Heck, if you could find the intraday setup that sweeps the low again and finds a higher low inside, risk, reward, that to me is very interesting here out of Apple. You're at a key inflection point on the daily, and even if it does break down underneath, you have that weekly line in the sand as well. So it'd be very, very difficult to try to build the short case here out of Apple up against this big retest level. Amazon, this one's just in a daily balance range, another one that's sort of the epitome of the broad market itself. However, the context here is that it's a bull flag. As long as you're over 220, it's hard to be a bear. Even if it does break down, I've talked about this gap fill reversal for quite a while here on the channel now. I'd be very interested in the 50 SMA gap fill reversal at 214 for a long, something that looks like this. Again, count me in. Want to be long here. Risk reward firstly has to accommodate the bottom end retest of the balance. If it rejects, you have to be mindful that, okay, we're flipping into a stronger daily downtrend. But until proven otherwise, it sort of sits more so, in my mind, as a daily bull flag. Get involved here, or getting involved there makes a little bit more sense as an executable setup. Something along those lines would be a little bit more attractive. Moving along to Google. I've really not been a fan or too fond of Google's daily time frame chart for a little while now. I was a big proponent for, you can hear me, you go back, listen to the archives. I'm not just saying this because Jensen said it. The quantum computing boom is 15 to 30 years out. And, Jensen pretty much nailed it on the head. If you're involved in the computer science space at all, you sort of knew this. So I had been skeptical of the Willow chip. It's a cool breakthrough, but what's the business case for it? It's really not there. I had been scouting this head and shoulders for a long time, and the fact that this broke out of what could be considered potentially like a symmetrical triangle along these lines was really sort of perplexing to me. Outside of the fact that maybe it's just holding out over its previous all-time high from back here. We'll give some respect to just the simple technicals. But the daily chart now is just in the midpoint of that apex of the triangle, and I don't think that there's an edge there. So a little bit of a frustrating chart out of Google. So for that reason, we'll just let it be into the future here. What do we see out of the metaverse? Zuckerberg strikes again, right? Hiring Dana White to the board of Meta. Some people pretty upset about that, but nonetheless, the stock is holding up okay over this double bottom, over the 607.75 prior lows from the balance range back here. I like the daily hammer that was produced today. Here it is in the hourly time frame chart. I like the sweep and the higher low that's starting to hold into the afternoon. As long as we can stay over 607.75, I wouldn't want to see another move underneath. As long as we're above that, I would be thinking about rotations back to the upside, purely based on the constructive look of this chart here, right? And I think, just if you can read between the lines of what Zuckerberg is trying to do relative to the new administration. He's trying to like cozy up there, hiring, Dana to the board. It makes sense that, the stock is going to not be hit as hard, let's say, when it comes to potential changes from the new admin. So just something to think about there. Anyways, Tesla, what's going on? Lower high continues to persist here, sort of off of that previous all-time high, as well as the neckline of the double top from right there. So my thoughts on that would just be that I think that it's possible we get our gift. This would be the holy grail setup. If Tesla could continue in the downward direction, give us the retest of the big breakout level from back here, closer to 358.50, daily 50 SMA. Show me that rotation. This is like a gift from the market gods. Risk, reward, straight back to the neckline, and hopefully ballooning runners back up towards highs. Yes, you've got to contend with earnings, and the idea here is not that this plays out over the span of an hour, 2 hours, 2 days. This could take some time, but the general idea is that from a range perspective, you would want to be a long here, not a new money short, right? That makes sense for being long, risk reward wise, back to the upside. So watching out for that with the sustained lower high here. If we take it down to the hourly, we'll notice that there's sort of a hold happening over this previous high from the gap down on the delivery numbers. It's possible that a hold of 392.70 holds it for a higher low. I wouldn't be long into 415 like that. I would more so think that the right side of the V gets interesting on a higher low back on a recapture above. Maybe this is just the low of the move over here. So to be bullish, it's got to be that. But for now, sustained price under 415. It's got to be bearish first, and then prove it to me. I'll change my tone to long, right? Unless, of course, it's that full tested level down here. Next up, JP Morgan. We talked about it already. Moving along to Netflix, a really ugly chart as well. Just going to remind you guys one final time. So do with this information what you will. Let's go back to an auto zoom, please. Think or swim. Consolidation pre-earnings, gap, go. Consolidation pre/post earnings goes for a crazy run. Consolidation pre-post earnings goes for a nice run. Consolidation pre-post earnings goes for a huge run. Does it have to do the same thing this time around? It doesn't have to do the same thing, but Netflix has clearly been exhibiting this pattern. It will stop, and at one point it won't work, and you can come back to the channel and say, oh, you're such an idiot. Why the heck would you trade based on such a rudimentary pattern? You wouldn't. It's just one idea to add into the narrative of what's happening with price. If it can support a higher low here, then great, but it's usually one of the first names in the tech sector to report earnings, so we'll see. We'll see, right? So as it consolidates and cools off here, maybe it's just putting in its nonsense range before doing what it does post earnings. So that's my take on Netflix. We'll leave it off at that. Let's move along to AMD. The advanced money destroyer does it again. Cathie Woods does not keep the price afloat. Come on, Kathy, you're supposed to buy at 10 o'clock. Mike told me. Shout out Mike if he's listening. Here we go. Inverted head and shoulders. It played, but promptly failed. No hold of 122.20. It's a bear flag underneath. I think that you've got a very simple trade to watch for tomorrow. Under 120 breakdowns should bring you closer. Under 120. My apologies. Brings you closer to 116.25. Finally, I've got 4 trade ideas for you. Can you believe it? There's still more. ORCL. Oracle is the first one up on the chopping block. Let's rip through these. This is the key. Don't come back to the channel and try to say I told you so. If the broad market is bearish and continuing to break, or I shouldn't say continuing to break, but if it's threatening the break of the head and shoulders neckline in the S&P, if the NASDAQ's breaking underneath the equal lows, Oracle is a short as long as it stays underneath 165. Bear flag consolidation, continuation to the downside, looking for the thin structure retracement, and then there's an earnings gap underneath, all right? So that is the look here out of Oracle. You could start to say left, head, right shoulder, neckline here. It doesn't matter what you want to call it. We've been under the 50 SMA. We have a sequence of daily lower highs, daily lower lows. We're in a downtrend under 165. I think it can continue to play in the downward direction. That's Oracle. Keep it simple. Next up, TSM. Let's take a look at some semiconductors. TSM, how are we? Just like NVIDIA, huge retest of a breakout level. You could call this weekly inverted head and shoulders. Doesn't matter what you want to call it. The level is undeniable at 205.25. If this can support over 205.25, I think it sets up, like NVIDIA, some opportunity to navigate the range as risk reward along these lines. If we can find buyers at 205.25, that's interesting. Here it is on the hourly time frame chart. A sort of, what would you say? An entry that's worth entertaining is two ideas here. Sweep 205.25 back above, sets the inverted head and shoulders. Over the neckline, long, looking for moves back in the upward direction. Obviously, respect your targets, please, but generally looking for upside. The other one is that this gives you the Stevie Wonder off the open on Friday and finds acceptance for a higher low over the prior all-time high at 212.25. I would want to be long here for risk, reward, and ballooning runners up towards the all-time high. That is TSM in a nutshell. Next up, we have PLTR, another fan favorite, Palantir. Thank you, Alex Karp, for a just absolutely record-breaking 2024 on the push to the upside. But unfortunately for Alex and crew, the head and shoulders, right? That's the theme of the market right now. All of these head and shoulders everywhere. The neckline has been absolutely brutally snapped. Somebody send an ambulance. Not looking hot. So what's the idea here? Any rallies to set lower highs? Unfortunately, under 71.15, get kind of aggressive for a short opportunity. So if the broad market's bearish, that's an idea for Friday. If it rallies and rejects, that's an idea. Or you could just even open closer to that 71.15. There's just a ton of overhead supply, right? All overhead supply ready to sell there for a break even. Now, the flip side of this coin, the beauty about PLTR is that it works for both bulls and bears. Because if you look at the daily time frame chart, which we were just on a moment ago, take a look at this. Big retest of the breakout level back here. You've got the daily 50 SMA. So you do whatever you feel works best for your portfolio. I'm not here to tell you what to do. I'm just here to point out the setups. I think this could easily play as a long idea from a swing perspective back to the upside. I would really want to see this if that's going to be in play. Or if you want to take the scalp short, looking for further pressure to the downside, 71.15 is your number. Last trade idea, the fourth and final, is VST. A little bit of a hidden gem over here. What I like about VST is just the fact that it's very, very respectful of its levels, as the broad market is just an absolute nightmare with its broad market levels, right? So notice this previous shelf of support. It's acting as support. It's doing what it should do. Notice this previous area of resistance acted as support. A little sloppy through it, but nonetheless, generally acted as support. So I like the fact that it's being respectful of its levels. Any consolidation up here sets up Brigade Bolt trades to blue sky territories over 169, underneath 153.75. I would just not touch it in here. I would really reserve VST as more of a long-sided trade idea versus trying to look for both sides of the trade in this name. And that's going to do it for today's episode of the Midweek Market Update. Once again, I appreciate you guys coming out to the show. The market will be closed tomorrow in remembrance of Jimmy Carter, so do not expect the market to be open. There will be no trades to be had. We will resume on Friday with, of course, the pre-market prep. We'll see if we do a session tomorrow morning. It depends on how we wake up and how we feel, whether or not we want to do some scans or something like that, hang out with the crew. We'll see. We'll see. So put YouTube notifications on, subscribe to the channel, like the video if you learned something new today. Leave a comment down below. Let me know how you feel about this balance range up here. Do you think it's a load of nonsense I'm talking about? Do you think it's going to resolve higher, lower? It really seems to bring out the worst of people. Or maybe I shouldn't say the worst, but rather the most emotionally charged. Strong conviction. You ask people on X, it's, oh no, this thing's going to break to 700 over the next couple of weeks. Or, oh no, it's going to go to 0 over the next couple of days. So it brings out the extremes of folks. Anyways, pleasure chatting with you this evening. Hopefully you have a fantastic rest of the trading week, and we will see you in the next one.